Hi, my name is Jeroen Hoppe from the Clapham property blog, and welcome to video 12 out of my 30 long video series. Today I'll be talking about when you should be taking out a fixed rate mortgage. Right, well, dive right in. I'll come out and say it straight away. I think you should never take out a fixed rate mortgage, and here's why. Interest rates are historically low, and people are saying, well, they're only going up, but that's completely true. But like with anything, you pay a higher cost for certainty. Like people sticking their savings in the bank, you obviously get next to nothing, but it's very safe, and therefore people still do it. Same is true for fixed rate mortgages. They're very safe. Obviously, you know what you're paying for the next 3, 4, 5, maybe even 10 years. But truth be told, you're wasting money. You can make a lot more savings by going variable rate. I'll explain why. Banks make money based on a margin. So for example, if they're offering a rate of 2.5% and the Bank of England rate is 0.5%, like it is now, they're making a 2% margin. So 2% is their markup. And there's all sorts of other things like swap rates, LIBOR rates, all that sort of business, but I won't go into it. We'll just talk about the margin. So they're making 2% margin. Now, say for example, if your broker says to you, well, I've got this other fixed rate product and that's 3.5%. Well, quite easily you can deduce that the bank is making a 3% markup. Right, so at what point are you better off? Well, the banks are obviously susceptible to interest rate changes just like you are, but the interest rate would have to go up and up and up and up over and above a certain level for you to be worse off over that 5-year period. Because if the rates start rising, you instantly pay a little bit more on a variable rate, but the person on a fixed rate mortgage is still paying that higher rate. So the rate would have to go above and beyond where the fixed rate is for a considerable period of time until that person that's on the variable rate will end up paying more. Now, I have some visual aids here to show you. Now, here we go. I've got this graph here. This is interest rates going up at 0.25% every 6 months. And you can see the different lines here. Let me just zoom in closely on that and hopefully you can see that. Yep. So here you're actually worse off with the variable rate by about £875. But bear in mind, this is interest going up 0.25% every 6 months. So that's quite a steep increase. I don't think that's very likely. Second graph I have here, this is interest rates going up at 0.25% every 18 months. So this is a much more conservative increase in rates, and you'll see that the person who's on a variable rate is actually £9,300 better off over the term. Now that's a big difference there. Obviously that's a really good scenario there. What I think is more likely is that interest rates are going to go up steadily over time, probably about 0.25% every 12 months. Now that's only my prediction. I'm not an economist, I just know a lot about property, and this is what I think is going to happen, so don't take this as gospel. But here we go. So you can see interest rates rising steadily over time. And in this particular graph, Mr. Variable Rate is still £7,500 better off over the term of the mortgage. That's a lot of money. £7,500 over 5 years, £1,500 a year, sorry. What could you do with £1,500 a year? You can definitely do a lot of damage with that, can't you? So there you have it. If you're looking to remortgage, always go for a variable rate. Now, if you're the kind of person that wants to play it safe, take that difference in monthly payments between a variable and a fixed rate mortgage and set it aside. Set it aside into a different bank account. Then if rates do start to creep up and they do go above where the fixed rate would be, at least you've got some money in a separate bank account to subsidize those payments. Now, I think we're a long way off from that, so you can be safe in the knowledge that you'll be better off with a variable rate mortgage. So that's it for this time. I hope you liked that video. Do like and share and comment down below. Share it with your friends, of course. And if you have any more questions, just send me a quick line on email, jeroen@claphampropertyblog.com. My name is Jeroen Hoppe. I'm a professional property investor. I've been working and investing in South London for nearly 15 years now. So if you need a hand with anything, let me know. come meet me in person at the Clapham Property Meet. We meet at the end of the month on a last Tuesday of the month over in Clapham Old Town. More details on the website claphampropertymeet.co.uk. See you next time.